For those of you who don't know, Tom Lee came out the other day and gave a 15,000 price target for the S&P 500 by 2030. Right now, the S&P 500 is sitting at 5,470. So Tom Lee is pretty much saying that we all going to get super rich by 2030. Let's take a look at this interview where he explained his thought process.
Let's ask the man himself because he's sitting right next to me. Tom Lee, good to see you.
Great to see you, Brian.
You have not been drinking.
No.
Okay.
Not recently.
Not recently. 15,000. I'm just going to sit here and listen.
Okay. Well, there's a couple of reasons behind this. One is this would be the third time that stocks entered a cycle where annual returns compound at high teens. You know, you had the roaring 20s, and then you had the 50s through the late 60s. Mm-hmm. And this is a third cycle. They all coincided with a surge in the number of people aged 30 to 50. So in other words, the number of prime age adults. And this time it's powered by millennials and Gen Z.
Just so you all understand what Tom Lee just said, he expects the S&P 500 to compound by double digits every year. That is 20% or more each year. Just to put this in context, for 2023, the stock market finished the year up 24%. And for 2024, we are currently up 15%. So Tom Lee is pretty much saying that we're going to finish out this year up 20%. 2025, we're also going to finish up 20%. 2026, 20%, so on and so forth, all the way till 2030. And then boom, the S&P 500 is going to be at 15,000.
So is this the law? Okay, so math. I wasn't not great at math, but I'd like to think I know a little bit. Big numbers get bigger faster. That compounding.
That's right.
And you think there's that, but there's also this massive wave of people about to enter their peak earnings years.
Yeah, so it's a...
Demographics.
Exactly. It's a demand story, meaning when you get to your prime years, 30 to 50, Urban Institute shows you start to borrow more money. You're making big life decisions. This is what powers the economy. On top of that, we have a really big opportunity for U.S. technology companies because of AI, which is supplying the global digital labor because there's a global labor shortage. So these two forces are combining to, I think, power almost a decade of extraordinarily good stock returns.
Do you have a view? Is this because we're the United States? I mean, and do you expect that a lot of money from around the world, because China's got massive demographic issues, Germany shot itself in the foot with all of its energy problems. Will we be helped by a lot of money coming into America, or does that have nothing to do with it?
It's actually both. I think that there's going to be a lot of dollars spent on U.S. technology product because the world is short 80 million workers by the end of this decade. That's roughly $3 trillion of labor shortage, of labor salary that's turning into silicon. So that means U.S. suppliers of silicon and AI are going to have a $3 trillion revenue run rate. On top of that, if U.S. companies are growing earnings at this speed, the PE multiple of the U.S. should go up, and that's exactly your point. There's going to be capital flows into the U.S. And where else in the world do you find the best and most important technology companies? They're all basically in America.
They're all here. I mean, it's amazing to me that NVIDIA alone, folks, NVIDIA by itself is worth 50% more than the entire German DAX index of stocks combined.
Yes.
The 30 biggest companies in Germany, or 33, however many are in the DAX, combined are half the size of NVIDIA.
Yeah.
Because we have liquid capital markets. We have American ingenuity. We have an amazing workforce. 25% of company founders, by the way, are not born here because we allow a lot of immigration. It's a bold call. What's the risk? When you look at it, you've always got to analyze, say, well, where could I be wrong, right?
Yep. Well, I think there's a risk that we could have
global recession.
A global recession. AI, of course, could become an adversarial development and, upend state nations and cause chaos. But we could also have a risk that it's a bubble and it peaks a lot sooner.
Yeah, and you wonder, by the way, this is a little bit off topic, but I saw some huge bets being placed, and there was a note today, and you forgive me, a senior moment, I can't remember exactly who put it out there, but that there was a huge bet placed in the interest rate market that the 10-year would be at 2.25% by like next March. that there'd be this massive decline in yields, either because of the Fed, recession, whatever. You have a take on that?
I mean, that obviously is a very cheap bet because I'm sure the skew is for higher rates, not lower.
So it's like a high risk but high reward bet.
Yeah.
Not high risk because you're not betting a lot of money, but the odds are you're going to lose your money.
Yeah, it's like a black swan kind of trade. I think it's possible because, inflation internals are collapsing. I think the headline core CPI, and we'll get Friday's PCE, they're being propped up by housing and auto insurance, which are two components. But the rest of the CPI index, 55% of the CPI basket is below pre-pandemic inflation rates now. It's the highest in 4 years. The 20-year average is 50%. So inflation is tanking.
Except for the home and auto insurance. That's a big deal.
Yeah,
But by the way,
money.
I heard there's going to be some big rate increases coming to New Jersey, folks, by the way.
Overall, his theory makes a lot of sense. He does own a research company, so he has a lot of data to back up his prediction. Also, you never want to bet against the US economy. Like and subscribe and check the description down below for some free stocks with Mumu, who is a sponsor of the channel.